Hi everyone and welcome to today's charity update webinar. Bit of housekeeping before we get started. If you are unable to hear me or see me, then you can log in via telephone. The details are on the screen. It is a live session, so I'm going to apologise in advance if there are any technology issues arising on today's session. If there are, I will hold my hands up and say I am not a technology expert. Please do feel free to ask any questions throughout the webinar using the chat function on the right hand side. And if there is sufficient time, I will answer as many of those on the session. If not, please feel free to drop me an email. My email is on the screen and will be on the final slide as well. The session is being recorded today and will be circulated along with the slides following the webinar for those who might not be able to make it or want to pass it on. So what are we going to be having a look at today? First of all, I'll do some introductions. We're going to have an overview of the last 18 months. We're going to have a look at some of the accounting challenges that we've faced as accountants and you as working in finance. We're going to have a look at the changes to the Charity Act 2022, which have recently been enacted. We're going to touch upon some of the audit changes that have occurred and look at how to prepare for the annual audit. And then we're going to have a look at some regulatory matters, brief overview of tax, including VAT and national insurance, and some other things that we think are coming up on the horizon. So a little bit about me for those who don't know me. I am Louise. I'm Head of Audit at Mitchell Charlesworth and have worked here for nearly 10 years, having trained in a firm in Manchester. I started working with charities very early in my career and have since formed part of the charity specialist group, headed up by Phil Griffiths, Alison Buckley and Rob Hull. I do lead on service delivery on a range of audit, but also non-audit matters for the not-for-profit sector. I head up our housing department, but I also work in a more close capacity with a number of charities on forecast, budgeting, management information, etc. As head of audit, I'm also responsible for the audit quality, training and development across the practice. So who are Mitchell Charlesworth? We are a northwest-based firm with offices in Chester, Liverpool, Manchester and Widnes. I suppose we really pride ourselves on being more than just your accountant. We really form a close relationship with our clients with a very partner-led approach. So let's get into everything. So obviously the last 18 months have been extremely different, interesting, and it will probably come as no surprise that COVID obviously is the first point I've highlighted here. But I think as we've slowly recovered from COVID, there are a much wider range of things that are starting and have been impacting. I think we're finally starting to see the impact of Brexit with the macroeconomic conditions that we're now facing, coupled with, of course, the unfortunate circumstances in Ukraine. But when I was actually looking at content for this webinar, having not actually done one for a couple of years, it struck me that actually there's quite a lot going on in the sector that is worthwhile of mention. And you know that there are a number of challenges, but also some positive attributes coming out of the changes that are being implemented. So the last 18 months have, as I said, have been really challenging, both operationally and financially. The impact on finances, obviously, as a result of the various lockdowns and restrictions and isolations, have meant that fundraising activity has been reduced and other income has also been challenged. We've seen pension volatility, specifically in the defined benefit schemes, but also boards are having to make vast investment decisions, how they're using reserves, what the reserves policy is. For those who are undergoing budgeting and forecasting, I can imagine it's been quite a frustrating time with the level of reforecasting that's had to be completed. However, there has been government support, which I think has been very accepted by many and has been sort of a lifeline during this period. But it's also given rise to potential impairment issues, insurance claims, whether that's through business interruption or the likes. And we're now seeing these macroeconomic conditions with rising inflation rates, rising fuel and energy bills, and rising cost of living, and obviously offsetting that with the ethical pay considerations that we in the sector have to consider. But I think by far the impact has been on operations, and we, as much as our client base, have really found difficulties with finding the resources, whether that's due to long-term sick, isolation periods, or people changing within the sector. And obviously closely linked to that is the staff welfare and well-being, which has been at the forefront of everything that has been being delivered. I think we're seeing quite a lot of restrictions and changes in the delivery of programs, whether that's been remote or a hybrid, but also those now coming back into fruition. All of the issues that have been faced across the sector have also given rise to a number of governance issues, and I know certainly from a board's perspective, meetings have been far more frequent, decision making has been more widely accepted, and there have been quite significant issues. Across many sectors, there's been pressures on services and delivery, and reduced capacity to deliver on what people want to be delivering. From a volunteer perspective, I think we've seen challenges in the same way as the staff resourcing, but also opportunities with people taking maybe early retirement over the last couple of years, reassessing sort of their life aims and goals. So we do see that there is probably some scope on the volunteer arena to develop. Cyber risk, I'm going to touch upon later in the webinar, has also been quite a significant risk, and we are seeing a number of charities being targeted by cybercrime. Safeguarding, it goes without saying that obviously from a safeguarding point of view, with all the issues and challenges around resources, staff welfare, isolations, safeguarding has sort of been elevated from a risk point of view. There's also been a lot of changes from the technology point of view, with a lot of digital transformation. Many organisations starting that journey sort of 5-6 years ago, but it being vastly accelerated by the recent events. But I think looking at it from a positive point of view, what we have seen is a lot of collaboration between us and our clients, as well as clients with each other and charities working together. And also a lot of diversification in looking at alternative income streams, that looking at different ways of programme delivery. And really that diversification has led to a lot of success and change over the last 18 months. That being said, from an accounting point of view, we haven't really seen any significant changes in the SORP since the update back in 2018. But instead, what we've seen is actually new considerations around the existing financial reporting framework. Highlights here some, the first one being valuations. Obviously with COVID, it was very difficult in some circumstances to actually get third-party valuations, whether that be restrictions of access or obviously data. But particularly around property and defined benefit schemes, those valuations have been quite adversely affected by the fluctuating markets. And certainly from a property point of view, we've seen some real highs over the last couple of years, and now that's starting to stabilise. From the defined benefit scheme, I think the biggest issue has been around these huge swings in valuation, which have led to significant surpluses or deficits on the schemes over the last 2 years. We would like to have thought that coming out of COVID would have stabilised that, but I think with the economy and obviously the Ukrainian war, we probably won't see that sort of stabilising just yet. And I think from that point of view, it's really imperative that from a board perspective and the users of the accounts, they're understanding, obviously, that the defined benefit adjustments each year don't form part of the overall performance of the charity or organisation. From an impairment point of view, obviously each year you are duty bound to review your assets for any evidence of impairment, and we've had a number of factors that would give rise to a potential impairment. Looking at fixed assets, obviously from a property point of view, with the hybrid working and going off site, there was potentially impairment there. From a debtor's point of view, obviously the challenges that have been faced by a lot of organisations and individuals, then the potential of recovery of debtors has been a challenge, and also may give rise to increased provisions against those. And those of you who have stock, obviously, if there are no longer certain revenue streams, if shops have been closed, then there's potential impairment of stock as well. I think one thing that we have been sort of tasked with liaising and assisting our clients with has been around the provisions. Obviously, from a provisional point of view, it has to be contractual, it has to be as a result of past events, probable and reliably measured. So the criteria is quite stringent, but actually the way things have gone in the last 2 years, there's been quite a lot of staff and organisational considerations and restructuring. So provisions have been a lot more in play, along with the consideration around, well, are those provisions actually exceptional items and need to be disclosed slightly separately to the usual operations of the entity. The other key thing that we've been working with clients on is revenue recognition, and I think from a revenue recognition point of view, the SORP had already led us to quite an ambiguous financial reporting, certainly around the recognition of the likes of legacies, whereby the recognition point is quite different to the received point. And obviously with COVID, it's also led to other things, for example, the valuation of donated goods or services, and how to recognise those fundraising events. As I've touched upon, I think for the pension volatility and the market conditions have played a big part in that. And obviously reporting at the balance sheet date is a snapshot in time and doesn't give the full picture of the ups and downs over the year. We've seen quite a lot of bank restructuring and also challenges with banks. The two key things here, I suppose, are looking at, well, if there's a breach of covenant, is there a letter or an agreement with the bank that they're going to mitigate that? But also the disclosure of loans if they are being restructured and refinanced between the under 1 year and over 1 year. And finally, I suppose, linked to revenue recognition, we've seen new government grants come into play, and particularly the furlough grants, which, whilst being part of the wages and salaries, could not be net off and was reported as income. But also from a taxation point of view, those who have had to produce tax returns over the last couple of years will have had to report through the tax return the receipt of that furlough also. I think from both our point of view and many of our clients, going concern has been quite a significant adaptation during the last 2 months. And nothing can emphasise enough that actually it's the board's responsibility to assess the going concern position. I've identified some things because I think a lot of people think, oh well, if we've got a surplus, we're absolutely fine. But actually there's a bit more to consider. The availability of cash and future headroom, the net current asset or liability position, the level of reserves and those that are free reserves, the history of past results. Obviously, if you've got regular losses, there's an indicator of going concern problems, but actually there may be more of a story to that, dependent on the level of reserves. But really key in the board's assessment is the future plans and budgets. How are things looking moving forward? How are those budgets going to be implemented and what's the strategy around it? And of course, if there's any indication of breach of loan covenants, then that's a separate discussion also. I think it's really important to note that obviously, having said that it's the board's assessment of going concern, if there are a couple of indicators that give some doubt, the financial statements can still be prepared on the going concern basis, but we would encourage that the conditions that exist and what the board are doing is disclosed both within the trustees report, but also as a note to the financial statements. And just touch upon our view of going concern, it's our role as auditors to assess the board's use of the going concern assertion and report in our audit reports upon that. And you will see when we come to have a look at some of the audit changes that that is now a positive statement of going concern. And as a result of COVID and Brexit and all of these sort of economic conditions, we are having to do more work on the going concern, as we'll come to. I suppose the biggest change in the last year from a Charities Act point of view is the fact that we now have some amends to the Act that came in a couple of months ago. There are quite a number of changes, but I've tried to cherry pick some of the key ones that I think would be useful to highlight. From a fundraising point of view, there's always obviously been a requirement that if a fundraising is for a particular purpose, it must be spent on that purpose. What they've now brought in is actually if the fundraising appeal individual donation is below £120, charities will be able to repurpose that money on a similar project. For those of you that work on an incorporated entity, for example, a trust, there is a new permission to amend your constitution more easily than there were quite a lot of barriers previously. They are making it easier. There are also changes to how charities can amend their objects. And I think here it will just make it simpler if there are minimal changes. There will still need to be consultation with the Charity Commission and permission, but they are making it easier for minor amendments to be passed more easily. There is going to be more flexibility when getting advice on the sale of land. Historically, there's had to be a small number of chartered surveyors brought in to get that advice, which can be quite expensive and timely. But they're now getting more flexibility that you can obtain advice from a wider range of advisors, which should make it cheaper and also quicker to get the process completed. From a permanent endowment position, obviously this was where funds are given to the charity, almost forever. There is the potential to invest more freely in that respect, and it includes a change which will allow trustees to borrow a sum of up to 25% of that endowment value. They will also be able to pay trustees for goods and not just services if they're not expressly stated within the governing document. Still need charity commission permission for over 20,000, but goods below that amount will be allowed to be made. So quite a few minor changes, but all easing the burden of the Act on charities and giving a bit more flexibility across them, and giving people the time, the board the time to actually run the charity as opposed to going through a number of challenging and red tape. As I touched upon earlier, we have seen a number of audit changes over the last 2 years, both from a standards point of view, but also from an operational point of view, as we have all seen. We've slowly come out of COVID, but that doesn't change the impact on our risk assessment and looking at each of our clients from a operational risk point of view, as well as a financial risk point of view. Challenges in gathering audit evidence remotely, albeit we are pushing now to getting back on site. The ability to obtain evidence via experts, for example, as I touched upon earlier, the property valuations. There have been delays in a number of circumstances with actuarial reports coming through. Assessing judgments and estimations. Now, this is difficult in the best of times, but when you've got a lot of other challenges put into the mix, we're having to do a lot more work on what the board and the senior management team's judgments and estimations of certain accounting treatments are. And as we've already touched upon, looking at that going concern conclusion, the impact on the audit report and what's happened post year end and how does that affect our conclusions in respect of going concern. We did see changes in reporting deadlines and flexibility from both Companies House and the Charities Commission in relation to those reporting deadlines, which led to some challenges in timing of delivery of audits. But we're starting to see those being pulled back, and certainly from a Charity Commission point of view, they're far less flexible now with any amendments to the reporting deadlines. There have been some key revisions to the auditing standards that we have to follow, and you may or may have not noticed that we may have been asking for slightly different things during the audit process. The going concern ISA was revised to deliver this concept of standing back and looking at the bigger picture, getting a deeper understanding of management's assessment of going concern and fully scrutinising and performing some sensitivity analysis on the assumptions used in forecasts and budgets and in their assessment of going concern, but also ensuring that there was sufficient and appropriate evidence in reaching that conclusion. From an audit report point of view, you will see that the audit report is no longer a couple of pages and can go up to 4 or 5 pages. And this is a result of both a positive assessment of going concern on the audit report, but also our reporting on fraud and irregularities. And it's that reporting on the fraud and irregularities where we've had to be a lot more explicit in the actions, the procedures that we take in order to assess and detect fraud and irregularity. Ultimately, we are not there with the purpose of finding fraud, but our audit procedures should be designed to be able to detect, assess the control environment and understand the risks that your entity is facing. One thing I do always say about that audit report is actually it's quite a useful document for the board to review, because it does outline the procedures undertaken and help guide them to what is and isn't done as part of the audit process, and also help them understand their own risk assessment. The other key change over the last couple of years has been the accounting estimates. So this is a retrospective review of management's estimations, looking at prior periods and comparing them to what actually came into fruition. A separate review of each estimate from a risk assessment, looking at not just the inherent risk of the estimate, but also the uncertainty, how complex that estimate is, and how subjective it is to understanding of that estimate, and the level of management judgment exercised within it. So you'll have seen that we are doing more work around these areas to demonstrate that those judgments and estimations are being appropriately applied. I'm just going to touch on here about the audit process. As I've mentioned, we are seeing a return to on-site working, which is fantastic. But what we're also seeing is actually some of our clients have quite liked the remote working for the ease of data transfer, and just for the whole concept of being able to work in remotely and slightly different time. I think from how you can prepare for the audit process, that planning really is key, and understanding what you want from a hybrid model, a remote working or an on-site model. Agreeing if it is going to be hybrid and remote, what platforms are going to be used for that data exchange. But the real key for us is the preparation of the additional information, having forecasts and budgets prepared and available that have been approved by the board, along with the assumptions that have been used in arriving at the figures. I think it goes without saying that communication and early engagement is key. I think from our point of view, the audit process is not an end of year process, it's continual. We like to speak to our clients about things that are going on, help them reach decisions so that at the end of the year, there aren't any surprises for either party. And we open that dialogue nice and early as things arise. And obviously agreeing the letter of representation contents. I think it's really important here to emphasise that the letter of representation is actually your letter to us, and it should really highlight everything that you need to tell us and everything that you've told us. So reviewing that early in the process does give better understanding to the board about that content. Okay, a couple of other regulatory matters that have arisen. There was a governance webinar that myself and someone from DTM Legal, Alison, and I delivered, I think it was just before Christmas now, which was more aimed at board members and particularly new board members about their roles and responsibilities. But from a more general point of view, we have seen some shake-ups, I would say, in the regulatory matters arena. There's been an update to the Charity Governance Code back in 2020, which really focuses on the integrity of the board and equality, diversity and inclusion. There was an update to the Code of Fundraising Practice back in 2019. And obviously, we're seeing from a risk assessment point of view, boards have to be far more aware and on the ball with a number of areas: Brexit, the macroeconomic conditions, COVID, IT cybersecurity, data protection, safeguarding reputation. So all of these things that have arisen over the last 2 years need to form part of the board's risk assessment and discussions to ensure, from a regulation point of view, the entity is in the best position. As we've seen, there have been some shortfalls within the sector over the last couple of years, and as a result, the Charities Commission has, released some reports in relation to the particular shortfall a couple of years ago, and it's really done a full review of how it happened, and the ultimate conclusion has been around the board composition and behaviour. and how the board leads and influences those beneath them. And it's really important here to consider the skills and experience of the board, that they're acting in the best interest of the charity, that they're given the appropriate training, and that they are looking at continuous improvement. They've also highlighted that far more focus on the charity governance code is needed. They've also highlighted the role of financial planning and having a robust reserves policy in place, how you consider growth in your forecasts and budgeting and your future strategy, and how you're going to implement that in an effective and resourceful way. They've also looked at risk assessment and the mitigation, and there just isn't the right level of risk assessment taken on some larger charities to actually not just look at what the risk is, but how you are going to mitigate it, what controls are in place. They have released a reserves regulatory toolkit, which is available on their website, and it is worth a look. I know from our point of view, it's something that we do have quite a lot of dialogue with boards and senior leadership teams around, well, what should a reserves policy look like? And it's not a clear-cut answer. Each entity is going to be very different in respect of, what running costs are, what available streams of income are, what happens if a certain stream of income doesn't come in. So it is a very, very tailored approach to forming a reserves policy, and this toolkit does aim to assist with some of the considerations around that. And it's also looked at the funder's role in encouraging good governance. So a lot of entities which have grant funding from, local authorities, government-run institutions, it's as much up to them to ensure that they are giving to organisations that practice good governance as it is for the entity receiving it. I think from a financial governance point of view, that falls at all levels of the organisation. And I think not just from a board composition point of view, but also from a senior leadership team, right down to the finance department, there really needs to be clear structured roles with the right skill base. Effective meetings need to be held, and that's not necessarily quantity, but more quality of those meetings, having a clear agenda, understanding what the challenges are and embedding that into the agenda, and reaching decisions. It's all well and good having a meeting where there's a lot of discussions taking place, but it's really crucial that decisions are made and agreed upon, and actions can therefore be taken. Assessing the annual strategy well in advance to make sure that all parties are buying into that strategy, and understanding the strategy as much as possible so that there can be a positive implementation. For the larger entities, use of subcommittees, finance and audit, risk, HR, the use of subcommittees can help channel the skills and also get better outcomes for more specific finer details. I think we're seeing more and more now, certainly over the last couple of years, that financial planning is really key. And I know from a charity point of view, a lot of charities may say, well, it's really hard for us to, to budget what income we're going to get because of the nature of it, whether you're heavily reliant on legacy income or particular one-off event income. So that financial planning is really crucial in sort of building a budget from bottom up. What's our cost base, and what do we need to be able to, cover that cost base without using our reserves? From a financial controls point of view, really linked in now to risk assessment and assessment of irregularity and fraud. The financial controls that are put in place in your entity will really enable the reliance, the trust within the organisation that actually things are being governed from a regulatory point of view, that the procedures are in place, not just to deliver the year-end accounts that are reliable and accurate, but also to avoid the pitfalls of, for example, cybercrime, collusion, fraud within the organisation. Touching on financial reporting, we say this quite often, ultimately the financial statements are the board's financial statements. Yes, accountants and auditors can assist, but ultimately it is their responsibility. And linking that back to the going concern, linking that back to the trustees' report, the financial reporting requirements do require time, effort and consideration. And the final point really on here is just the oversight of the senior leadership team and making sure that there's the appropriate level of delegation of day-to-day responsibility while still having the financial governance in place. Okay, so just touching upon some of the key tax considerations. I think obviously just touching on what the exemption actually means. If you're a registered charity, there is an exemption to tax, but that is only if the profits are applied solely to the purpose of the charitable company. So what does that mean? Well, it means that the trade is exercised in the course of actual carrying out the primary purpose of the charitable company, or it's mainly carried out by the beneficiaries. So there may be a point at which you are generating income that is outside of the objects or the primary purpose of your organisation. There are certain permissions to that level of charitable, non-charitable income, where the turnover or the income from that stream is less than £5,000, or whichever is the lesser of £50,000 and 25% of the charitable company's incoming resources for the accounting period. So it's really important from a perspective of analysing, is there any income in your organisation that doesn't fit that charitable exemption to tax? If you do incur non-charitable expenditure, then the income equivalent to this is then taxable. So some examples, if a non-charitable trade incurs a loss, then the loss is taxable income and needs to be reported as such. Or if a loan is granted for non-charitable purposes, then the loan amount then becomes taxable income. Also, and we don't see this very often, but we have seen it a couple of times, if you're developing properties for a non-charitable purpose, then that is also taxable. A couple of other considerations from a taxation point of view. Gift aid. Now, gift aid is one of those administrative burdens, but actually can result in quite considerable amounts of money coming back into the entity. The government have said that they are going to give a 3-year transitional relief for gift aid when the tax rates reduce. So obviously it's 90% now, they're going to increase to 24%. So between now and 2024, they are going to give some transitional relief. The small donation scheme, it's still there, it's still working really well, and this is where you're getting smaller level of donations and you're not requiring a full declaration from the giver. And it's really important that actually you bear in mind that that is available, because we do see some charities where that always isn't being applied for. And obviously from a reporting point of view, making sure the compliance with the reporting of the gift aid, you have all the declarations and you have all the backing for those claims that are going through. Touching on some VAT considerations, and I think it's important to just note here that charities are not VAT exempt. The VAT and the corporation tax are two completely separable things. So just like non-charitable organisations, you must register if your taxable income is over the threshold. And quite a lot of times we see that actually the VAT considerations are usually more prevalent in the trading subsidiary. But that's not to say that actually VAT is a significant cost and a burden for those charities that aren't VAT registered and can't recover any of the input VAT in which they can incur. There are some reduced rates for fuel and power in specific circumstances. And there's also zero rated supplies for charities in some particular areas, for example, advertising or items for collecting donations, equipment for making talking or browsing books and newspapers, obviously medical, scientific equipment, if you are buying goods for disabled people, or rescue equipment. Obviously VAT can only be reclaimed to the extent that it relates to taxable supplies, and we see a lot of charities having this partial exemption calculation and annual adjustments to be completed in order to be compliant. There are a couple of things that you can do to sort of reduce that level of irrecoverable VAT. We're seeing increasingly the use of joint contracts of employment, whereby a charity and a trading subsidiary will have a joint contract of employment, and that means that costs can be recharged from one to the other without any VAT implications. We're seeing VAT groupings, whereby charities registered for VAT subsidiaries are forming a VAT group. And obviously charity events also raise the question of VAT, particularly in that the VAT incurred by the charity, if it's an exempt event, you will not be able to recover those costs back. But if you can recover any of the VAT back if they are directly attributable to making taxable supplies within the event. So it's understanding the income that's generated from the event and what is charitable and non-charitable. Just some other items to touch upon from a stamp duty point of view. There is a general charitable exemption. However, the land does need to be used for charitable purpose, and the exemption will be disapplied if the land isn't used for charitable purpose. So it's just assessing what you do and don't have as to whether that stamp duty on tax is due. I'm not going to go into significant detail, but there are cultural tax reliefs available for particularly the theatre, orchestra, museums and galleries, which can lead to some income from HMRC if you are eligible to apply for those reliefs. And there's also social investment tax relief as well for those who are working within social investment. I think the biggest thing from a budgeting and forecasting point of view is certainly going to be the impact of the NI increases from yesterday. And we're now seeing the uplift of 1.25% being applied to the various classes, and also a national living wage increase of 6.6%. So with all the challenges we have with increasing energy bills, increasing inflation, we're now also seeing that staff costs are also going to increase. And just highlighting there that from a contractors scheme, it's not applicable to charities with exempt status, but needs to be watched carefully. I think from a tax point of view, I don't think anyone expects anyone to be completely tax experts. You should be monitoring the tax position. You should be monitoring new activities to determine if they're charitable or non-charitable. Looking at structures, whether there's a requirement for a trading subsidiary for that non-charitable activity. And an annual review of your current schemes, for example, your VAT, to ensure that you're still complying with the charitable trading. And, you know, as I said here, it's very important to be aware of the general tax and finance developments, but ultimately there is a whole network of professionals to take that advice from. So it is quite a complex area, and it's an area that you want to be doing right. Okay, I'm conscious, you know, we're closely coming to the end of our hour, so there are just a few other considerations that I thought would be useful to highlight. I've already touched upon this, but from a charity commission point of view, the time extensions to COVID and extending or not filing your annual return and accounts by the due date is no longer being granted. So those who may have been relying on that may need to reconsider. I've mentioned there around the SORP review. Obviously, the last review was back in 2018. We aren't expecting anything before this year, which means that any effective date wouldn't be before 1st of January 2024. But obviously, we will keep you updated with any advances on that front. We've touched on technology and digital transformation. Obviously, that has been invaluable to many of us over the last 2 years, but it also comes with its challenges and the management of change and the culture within organisations. But we are seeing that a lot of clients are becoming more effective, more efficient with data management. But coming to obviously the cybercrime, cyber risk management, this is an area of particular focus, I think, from both the Charity Commission, from us as auditors, and ensuring that you have a cybercrime policy and risk strategy is really imperative. You know, we've seen more and more over the last few years where, you know, hacks have come in, you know, they swiped servers and asked for money. You know, it is a real true risk and something that needs to be managed appropriately, whether that's bringing in an expert or bringing in someone who can, you know, review your policy. I also note here that obviously with COVID, there was an exemption to holding face-to-face meetings and that they could be remote, obviously dependent on the governing document. And that exemption expires later this month on the 22nd of April. So really important that you take into consideration board meetings dependent on the governing document. And I think, you know, from what's coming up, who knows, after the last 2 years, I think it's anyone's guess, but I know high on the agenda is going to be around the ESG reporting, you know, environmental, social governance. You know, there's going to be more emphasis on ethical considerations when charities are investing funds, whether that be, you know, in an investment portfolio. The environmental and green initiatives that the entities are undertaking, and making sure that, you know, you are fulfilling your role in the ESG arena. Climate change and net zero, again, you know, there's going to be a lot of dialogue around how we reach net zero as organisations. I think there'll be particular focus on this in the coming years. So it would be important to start those discussions early and start looking at your entity's strategy to reaching the ambitions. And the final point I just wanted to highlight was just around the levelling up agenda. Obviously, this means that there's going to be scope for more money, particularly in the Northwest, where most of our clients are based, and opens up some quite big opportunities for us and our clients alike. We don't know what it's going to quite look like now, but I'm sure over the coming year we'll start to see additional funding, additional grants being made, and I know the government's working very closely on some of their key initiatives with Arts Council and with other funders. And I think, there is a lot of fear 2 years ago when Brexit was being discussed that a lot of the, EU funding that we receive, and a lot of our charities rely upon, would cause particular challenges. And I think it's going to be really interesting over the next 12 months what the government is going to do to sort of replace those as they transition out. So that's everything I wanted to cover today. I know it's a bit of a whistle-stop tour over some subjects, so I'm more than happy to take any questions. Also, if you have any thoughts later on, please do feel free to email me. We have had a couple of questions through. One question was, I thought the tax exemption limit was 80k, now can you confirm? So I know the VAT threshold is 85,000. I'm not sure if that's what the person who's added this question in. So if you want to contact me to discuss that, whether it was VAT or corporation tax, please do let me know. But the VAT threshold is 85,000. That's if your taxable income is over that, you would have to VAT register. Okay, just seeing if there are any other questions coming through. I think one thing that it hasn't come through as a question here, but it did come through on a recent webinar that I did, was around the trustees report and the level of reporting needed in it. And I think it's probably relevant to say, actually, from a trustees report point of view, it is your opportunity to tell your story, and as much good news should go into there as possible, as well as putting some sort of topical subject behind if things haven't gone quite to plan. We've touched upon the potential restructuring provisions, potential impairments, and telling the story behind that will be particularly relevant. From a key criteria point of view, there are specific headings that the trustees report needs to follow, and they are predetermined, but ultimately it is and can be tailored as necessary. Okay, just seeing if any other questions come in. As I said, the webinar has been recorded, so the slides will go out, but if anyone has any other questions, then please do let me know, and I will get back to you as soon as possible. Okay, thank you very much everyone for joining us today, and I hope you've found the session useful.